Hello, everyone. Welcome to another Adam Live video. And on today's video, monster or massive tax deductions for the 2021 taxable year are still available. Yeah, they are still available to certain taxpayers. So listen up. If you are self-employed or have a small business with no employees, no full-time employees, and you have not yet filed your income tax return for 2021, you should be on extension. Hopefully you have filed an extension on April 15th or March 15th if you have an S Corp or a partnership. Then you have until September 15th for your S Corp or partnership, or until October 15th for your 1040 tax return or your corporate 1120 to file your tax return. Now, listen up, because there is still an opportunity, thanks to the Secure Act, to put away $58,000 in deductions or $64,500 in income tax deductions if you're over 50 years old. Yeah, this is the only available tax deduction still around, even though 2021 has gone bye-bye. So we are in 2022 now. And yes, you are hearing correct. You can still generate tax deductions of up to $58,000 or $64,500 if you're over 50 for the 21 taxable year in 2022. Okay, so how do you do that? Well, let's go back in time. Secure Act was passed in December 2019. Now, prior to the Secure Act, a 401k had to have been established in the year for which the deduction would be taken. So if you wanted to get a deduction for a 401k contribution in 2021, the plan had to have been set up in 2021. Okay, so the Secure Act was passed. It included a number of very attractive retirement provisions, including moving the RMD age from 70 and a half to 72, and some other really cool stuff. One provision that did not get a lot of publicity is it treated a 401k, especially a solo 401k, like a SEP IRA, which allowed a business, whether it's a sole proprietor, an LLC, a corp, a partnership, S corp, to adopt a 401k plan for its business in a subsequent year to which the deduction would be taken, so long as the business has not filed its final income tax return for the year. Okay, so remember I said sole proprietors, single member LLCs, and C corporations, they have until April 15th to file their return or an extension. The extension would be October 15th, where the final return must be due. And then you have S corporations and 1065 partnerships or multiple member LLCs that need to file by March 15th or an extension and file a return by September 15th. So right now we still have time. We have not passed September 15th yet. So what does that mean? It means that if you have a business, it could be any business, and you have no full-time employees other than the owners, their spouses. Spouses are not deemed non-owner employees. You can still set up a solo 401k plan for the 21 taxable year and generate up to $58,000 or $64,500 in deductions for the 21 taxable year. It's really the only available deduction that you can still take advantage of in 2022 for 2021. All other deductions have lapsed, whether it's entertainment, meals, depreciation, other related expenses, rent, employment. That's gone, right? 2022, once January 1 starts, no more deductions for 21, except retirement plans. Another reason why the retirement plan structure is such a valuable system for generating income tax deductions. So how does it work? So the one thing to keep in mind is, as of today in 2022, yes, you can set up a 401k in 2022 for the 2021 taxable year, but all you're able to contribute are the profit sharing contributions, much like the SEP IRA. But we know a solo 401k also has employee deferrals. right? For 2021, you can put in 19,500 or 26,000 if you're over 50. Those are deemed employee deferrals. And then the employer contribution profit sharing is the 20% of your comp, 20% of your net Schedule C, if you're a sole proprietor or a single member LLC, or 25% of your W-2 guaranteed payment or W-2 corporation salary, up to a maximum of the 58 or 64.5. So what I'm trying to say, in other words, is that yes, you can still set up a plan in 22 for 21, but all you're able to contribute for 21 are the employer profit sharing contributions. The employee deferrals technically only can be made if the plan has been established in 21. So yes, you can still set up a plan in 22 for 21, but only employer contributions can be made. So let's say you made 100K net Schedule C as a sole proprietor. If you set up the plan in 21, you'd be able to do 19.5 or 26,000 if you're over 50, plus that 20% of 100K or 20,000, giving you either 39.5 or 46,000 if you're over 50. But because the plan was not set up in 21 and was only set up in 22, the rules will only give you that 20% or that $20,000 deduction based off my example of 100,000 of income. That could change. There's potential, and this was in, I believe, the House version of the Secure Act 2.0, either the House or the Senate version, not sure. One of them had a provision in there that was going to allow a business owner who set up a 401k plan, let's say in 22, for the 21 year to also do employee deferrals. Okay, so hopefully the Secure Act 2.0 is expected to be passed into law towards the end of the year, so that going forward, likely in 23, if you set up a plan in 23, hopefully you'll be able to still do employee deferrals for the 22 taxable year along with profit sharing. But there's still a lot of deductions available, right? Let's say you made 200K and you were a W-2, you had an S Corp and you made $200,000 in salary, and you're watching the YouTube video and you're like, hey, this guy's onto something here. Let me ask my accountant if I have a solo K. It's just me and my business, or me and my spouse. You talk to your CPA, then he or she is like, yeah, you can totally do this. So on 200K, that's 25% of 200K. Okay, so that's real money that you can deduct. Now, let's say your spouse makes 100K. You would be able to do the 25,000 plus the 200 times 25, okay, which again is real money that you would be able to get another 50K, right? So if your wife made 100, she can get 25% of 100 is 25K. And if you made 200, you can get 50K. Okay. So there's real money of deductions. What are deductions? Deductions reduce your taxable income. That's the whole advantage of deductions. You want deductions. Any good tax lawyer or tax accountant, that's what they search for. Their biggest prize is finding you deductions. So if you could go to your accountant, or if your accountant goes to you and says, hey, you should set up a solo 401k in 22 for 21, you can still get massive deductions. Now, obviously, it would be better if you can also get the employee deferrals. But hey, if you set up the plan in 22, you'll get the profit sharing for 21. But going forward, you now have full advantage of that solo K, where you can get employee deferrals, which in 2022 is $20,500 if you're under 50 years old, or $27,000 if you're over 50, plus that 20% if you're a sole proprietor or single member LLC of your income, or 25% of your W-2, up to a maximum of $67,500 if you're over 50, or $61,000 if you're under 50. So the plan's going to help you in 21. It's also going to help you in 22 and going forward, hopefully, because when you set up a plan, it's supposed to be permanent. The idea is that as your business continues to evolve, you're still going to have your plan there and you can take advantage of the plan. Now, making contributions to a 401k are 100% elective. You don't have to do anything you don't want to. Obviously, the advantage is you get deductions and you take advantage of the power of deferral. Your money grows faster when it's saved through a retirement account because there is no taxation on the income or gains generated by the account. So you get two big wins. You get the tax deduction, which will make you and your accountant happy. And obviously you get the ability to defer the income or gains from the investments in the plan. So those are the massive deductions that are available in 22 for 21. So yes, you need to be self-employed or have a small business. You can have multiple partners. You can be in a situation where you have an architecture firm, let's say 5 partners and your spouses. So it could be 10 people. And as long as you have no non-owner employees that work more than 1,000 hours, excluding spouses, because spouses are not deemed employees for ERISA purposes, you can set up a solo 401k for your business. And then the 5 architects can benefit, and the company can make profit sharing contributions for each architect. So there's a lot of use. And then going forward in 2022 and beyond, the architects can also make employee deferrals, plus the company could make profit sharing contributions based off their W-2 or their guaranteed payment if it's a multiple member LLC. So just wanted to remind everyone that this is out there. You can do a SEP too, but SEPs do not have catch-ups. So if you're over 50, the SEP's only going to give you the 58,000 for 2021. You're not going to get the 64.5 if you're over 50, because SEP IRAs do not have catch-ups. But remember, you have to have not filed your final return. So you need to be on extension. If you filed your final return April 15th or March 15th, then still set up the solo K if you don't have one. So you have it going forward for 22 and beyond, but you're not going to be able to take advantage of any 21 deductions. But a lot of us are on extension and time is ticking, right? September 15th is around the corner, or October 15th, just a little over a month away. So there's still plenty of time to set up a solo 401k and take advantage of the massive income tax deductions that are still available. So hopefully people are watching this and or listening to it and says, hey, I'm not sure if I have a retirement plan. Let me ask my accountant. I'd love to generate more deductions. I did really well in 21. I really don't want to pay as much taxes as I think I have to. And again, what does a deduction do? It reduces your taxable income, right? If you make 100K and you get a $40,000 deduction, you only pay income tax on 60. And if that 40 goes to a retirement account, now that $40,000 can be invested in Tesla, real estate, cryptos, other stocks, mutual funds, ETFs, and all the income and gains from those investments will grow without tax. And that's known as tax deferral or compounding returns, with which Albert Einstein coined the 8th wonder of the world. So it's a double benefit, but you got to know about it. And that's the problem. Is I can't tell you how many clients over the last 12 years since I've been in the self-directed IRA business. I was a lawyer for 9 years prior, tax lawyer in New York, and I never knew that you could even buy real estate or do alternative assets or even have a solo K. And I was a tax lawyer. I have a master's in taxation. So that is my passion. That is my core focus, is to educate all of you, to let you know that, hey, you don't need to be a tax lawyer, have an MBA from Harvard to educate yourself about these important monster tax deductions that are still available. So I go on YouTube just like everyone else, and I'm shocked at how many people that aren't tax lawyers that are giving really good advice to people, and that's amazing. There's some really good videos out there of just regular folks that have watched my videos or other videos that want to kind of recycle that news to their followers, which is incredible. This is all about education. I don't care if you're watching my video or someone else's video, doesn't matter to me. The key is making people aware of the power of the retirement system. I've said this before and I'll say it again. It's literally rigged in our favor. It's a bipartisan supported system. It's the only system where Democrats and Republicans all agree, whether you are like Trump or Biden. Even Trump and Biden can agree that the US retirement system works. So the only hindrance is education, because too many Americans don't understand how it works. They don't understand the rules. They don't understand the concept of deductions. They don't understand the power of deferral. They don't understand that you can do different stuff in your IRA. If you don't trust Wall Street, you don't want to buy mutual funds or ETFs, you don't have to. you can do other stuff like precious metals or cryptos or real estate or private placements or hard money loans or tax liens or tax deeds. A lot of cool stuff you can do. So you're not stuck buying ETFs or mutual funds, but you can. And the goal and purpose is that your money grows without tax. Plus, you can potentially generate massive tax deductions. Or if you're a Roth lover like I am, you can withhold the deduction, basically say, okay, yeah, my accountant's not going to love me this year. I'm not going to get any monster tax deductions, but when I'm in a Roth, so long as I'm over 59 and a half, the Roth's been open at least 5 years, I can pull money from the retirement system without tax. Now, profit sharing contributions must be pre-tax. So as of today, since the Secure Act only allows you to go backwards doing employer contributions, the good news is they're all tax deductible. Only employee deferrals are Roth. Secure Act 2.0 also has an option in there, potentially, if it passes, that will allow employer contributions to be in Roth. But as of today, the law is employer profit sharing contributions are tax deductible to the business, which if you're a pass-through business like a sole proprietor, single member LLC, partnership, or S Corp, those deductions will pass through to you and reduce your taxable income. So I'm going to end on that. I don't need to kind of harp and compound, the point. The point is this: if you have a small business, you're self-employed, and you don't have a retirement plan yet, you haven't filed your final tax return, you're on extension, you're watching this video before September 15th. If you're a sole proprietor, if you're a partnership or an S Corp, or October 15th, if you're a sole proprietor, single member LLC, or C Corp, and you're on extension, you do not have a solo K for your business, listen up. This is the time to do it. You could potentially generate 20% of your comp if you're a sole proprietor or single member LLC, 25% of your guaranteed payment if you're a partnership, or 25% of your W-2 if you're a C or S Corp, up to $58,000 or $64,500 if you're under 50, and you're good to go. You're going to generate monster tax deductions for the 21 taxable year. And this is the only way to still reopen the 21 taxable year, take advantage of deductions, and reduce your taxable income for 21. You're not going to find another way to do it other than through a solo 401k or a SEP IRA. But remember, the solo K has a catch up if you're over 50, SEP IRA does not. And you're going to want to set up a solo K versus a SEP going forward, because you'll then take advantage of employee deferrals. Solo K also has a loan feature that lets you borrow $50,000 or 50% of your account value, whatever's less. Use those funds for any purpose. Plus, solo K has Roth features, SEP does not. In addition, if you're a real estate lover, then the solo has the option to allow you to do leverage on a non-recourse basis without paying the painful 37% max UBIT tax, where SEP IRA does not have that exemption. So when you put it all together, the solo 401k will beat the SEP IRA every which way. So if you're going to set up a plan in 22 for the 21 taxable year, you should go solo, and you still have time. So hopefully I piqued your interest, and talk to your accountant, talk to your tax professional. There's still some time. If you're on extension and you have a small business, no full-time employees other than yourself, other owners, or your spouses, go solo, set it up, takes a day or so, and take advantage of still potentially massive deductions for 2021. So thank you guys for watching. Really appreciate the support. And I will look forward to talking to everyone again next Wednesday, 12 Eastern. If you are watching this at a later point, thank you. And subscribe to our channel, because this way you'll get notified when I go live. And sometimes I'll just kind of go live at random days or random times if something of interest pops up, if there's a new case law or new legislation or just something in the news that is relevant to self-directed retirement accounts or investments or taxation, you'll want to know about it. So subscribe, it's free. And I think you'll learn something. I know you'll learn something. So definitely join the Self-Directed IRA Nation and become a IRA Financial subscriber. Otherwise, be well, take care, and thanks for watching.